the fucking Eagle Double G.
Therese Seryoso na.
3, 2, 1.
So, hi guys! Welcome to our
Wow.
channel. For today's video, we are going to talk about our main topic, which is corporate governance. When we talk about corporate governance, it is actually from the combination of two words, which are evidently corporation and governance. When we say corporation, it is a type of business organization that is owned by the shareholders and managed by the management. On the other hand, when we tackle about the governance, it is the leadership and direction given to a company so that it achieves the objectives of its corporation. Under the governance, we are always confused about the difference of it from the management. So when we say management, it is about making business decisions, while governance is about monitoring and controlling decisions. When we combine the two words, corporation and governance, we will have corporate governance, which pertains to the conduct of business in accordance with shareholders' desire, which generally is to make as much money as possible, which conforming to the basic roles of the society embodied in law and local customs. Now, corporate governance has a really broad scope. It includes both social and institutional aspects. Corporate governance encourages a trustworthy, moral, as well as ethical environment. In other words, the heart of governance is transparency, disclosure, accountability, and integrity. These four have greater demand when it comes to corporate governance. So in order for a corporate environment to live harmoniously, then therefore there should be a specific legislation that is not simply in words but a legislation that is being put into action. Next, we will have the two models of corporate governance. The old model is shareholder model. It is founded in classic economic precepts and it is the maximization of wealth for investors and owners. On the other hand, we have stakeholder model, which is a broader view of the purpose of business, and it includes satisfying concerns of a variety of stakeholders. To explain it fully, shareholder model is focused on maximizing the value of shareholders, while a stakeholder model is a broader view and is tied to balance the scorecard and includes satisfying concerns of a variety of stakeholders. Third subtopic that we have is the roles of boards of directors. To explain this broadly, we will have here the typical structure of a corporation or company. First, we've got shareholders. They elect your board of directors. Then, this board of directors, they oversee the executive team, which is the board of auditors. Under the board of auditors, we have accounting auditors, which is the external one, and these are independent auditors that are doing the audit, but we also have internal auditors that are in charge of the internal control system, and they also perform own audits on a regular basis. While both are to provide reports to the board of auditors, the internal audit reports will go to the independent auditors. They're going to use it in assessing the environment and then determining how much audit sampling they need to do. Going back to our main focus, which is the board of directors. Board of directors minimizes the chances of unethical or illegal behavior. Under the board of directors, we have various committees that you can have within a company. First, we have business ethics. Well, business ethics didn't really exist until a decade ago. Second, we have code of conduct and IT investment committee. These two are important because we want to safeguard the assets of the company and staying on top of the technology. Disclosure Committee. This is to make sure that financial information and other events are properly disclosed. Sustainability Committee refers to making sure that the company can sustain a certain level of performance of growth over the long term and making sure that they will stay innovative. Last committee is the Human Resources Committee. It is to consult back and forth again, and these are all consulting with the Board of Directors. For example, the employees of a company are having issues about incentive programs, and it actually causes too much pressure that can actually steer unethical behavior. So the board of directors wants to be unsure of incentive programs and how is that impacting the behavior of employees. To make it short, the role of the board is to plan and strategize goals and objectives for the short and long-term good of the company and to put mechanisms in place to monitor progress against the objectives. To this regard, board of directors must review, understand, and discuss the company's goals. Lastly, we have executive compensation, which refers to the financial payments and non-monetary benefits provided to high-level management in exchange from their work on behalf of an organization. Executive compensation packages may include base salary, stock options, personal benefits, perquisites, bonuses, and other benefits relating to compensation. One of the biggest issues corporate boards of directors facing is executive compensation. In fact, most boards spend more time deciding how much to compensate top executives than they do ensuring the integrity of the company. So to fix this problem, companies are paying enough money to prevent another company from poaching the CEO. It is by offering appropriate incentives for hitting goals to improve executive performance, finding ways to pay for rising executive compensation costs, and justifying huge gaps in salaries to other executives and non-executive employees.
Okay, that is all for today's vlog. Thank you for listening and hope you enjoyed our deep dive into corporate governance.
Give it to me like